Good afternoon, everybody. Sorry, good morning, everybody. I've lost time here. I'm so used to running
Morning.
these webinars. Not off to a good start this morning. So used to running these webinars in the afternoon. It's force of habit. My apologies. Good morning, everybody. Thanks very much for joining us this morning on today's complimentary webinar on strategic insights into the two-pot system, hosted by Masthead Financial Planning. We're thrilled to have you all join us this morning for an insightful session on the two-pot system and gain insights into the world of financial planning with our expert panel this morning. Without further ado, I'm not going to do my usual sort of lengthy introductions. I'm going to, first of all, welcome and hand over to Chiamo Knight from Masthead to introduce his team of experts who will be spending the next hour or so with us this morning. Chiamo, thanks very much for being with us and for your time and for the time of your team this morning. Can I hand over to you to take us through the presentation from here, please?
Absolutely. Thank you so much, Gordon. Good morning, esteemed SAEFA management and members. Thank you sincerely for taking the time to join us for today's webinar. We greatly appreciate your participation and the opportunity to engage with the organization. We are proud to be part of the Infinitum initiative, which is a strategic collaboration between the Old Mutual Black Distributors Trust and Masthead Financial Planning. This partnership was established to support and enhance financial services distribution within our communities. We are delighted about today's session. Our aim is to provide valuable insights and information relevant to your organization's needs. I will now hand over to our professional advisors who will introduce themselves and lead today's webinar. They bring extensive expertise in their respective fields and are eager to share their knowledge with you. Once again, thank you for your time and attention. We look forward to a productive and engaging session. Thank you, and over to you, Lincoln.
Thank you so much, Chiamo. Good morning, everybody. I almost said good afternoon as well, because this is probably my third meeting already for the morning. So I'm with you, Gordon. Thank you so much for allowing us to actually be part of this or to present this presentation regarding the two-pot retirement system. But just a brief introduction of who I am and my respective role. I'm forming part of the Infinitum initiative, where we are a group of independent financial planners powered by Masthead and also by the Old Mutual Black Distributors Trust to really offer valuable, holistic financial planning to everyone that we can actually engage with and partner with. So this morning session that we're doing, also just to mention, I see that the webinar has been set for 2 hours. Luckily, we are not here to steal a lot of your time to bore you with a lot of details. So at least we're not going to use up the whole 2 hours. But we just want to share information with you guys. Some of the information has already been shared. Some of the information you are familiar with, but this is also just to give a nice overview of really the two-pot retirement systems and also the questions that has been asked about it. Okay. So before I continue with the presentation, I just want to give you a brief background from my side. I've been in the financial industry for 20 years. I do holistic financial planning, but I specialized in short-term commercial, personal lines and commercial insurance. Yes, I also do all the other service offerings, but the group of guys in the Infinitum team is specialist in a different aspects in terms of giving financial advice to make sure that whoever we deal with, they're actually getting the best out of what they require at a specific moment in time. So I'm the short-term specialist. I know Nsako is also going to introduce her later and also explain what she also does on her side as well. So if there's any questions, I see most of the mics has been muted. If there's any questions, you may raise your hand, or you can put it into comments, or even after this whole presentation, you can also make contact with us if there is any questions regarding the two-pot system and also what we'll be discussing. Okay, so let me just see. normally one of my favorite things to do is to really to present in person. So please forgive me if I'm trying to look at at faces here. But yeah, let's continue. So the introduction of the two-pot retirement system, I know last year there was a big buzz around it. A lot of employers and employer groups were also running around and trying to get in contact with financial planners to also help and assist the employees. All right, but when we look at it, the two-pot retirement system, imagine a system that allows you to access a portion of your retirement savings when you really need it, while ensuring that also that the majority of your funds remain locked in for your future. So that's exactly what the this retirement system has been designed to do. When it was introduced on September 1st, 2024, this reform was meant to strike a balance between a short-term financial relief and long-term retirement security. Now we all know basically why actually it was implemented, because a lot of people would access their retirement funds early, and then at retirement age they would either not have funds or they would have too little funds to actually retire with, which means they would either continue working or they would probably rely on the social grant. So under this system, the retirement contributions were split into two separate pots, which was one, the savings pot that contained 1/3 of your retirement contributions, and then also the retirement component that remains locked until retirement, ensuring that the client has funds or that you have funds when you need it most. So let's break it down, these two pots down. We'll start with this first with the savings component. Let me just switch my slide, sorry. So the savings component is 1/3 of your retirement contributions that go into your savings component, which gives you the financial flexibility before you retire, but it's also not a free for all type of component, because there is strict conditions attached to it. This component just basically means that on the savings, you can withdraw only once per tax year, which is every 12 months. And the minimum withdrawal on that would be 2,000 Rand. And also, any amount you withdraw would be taxed at marginal income tax rate, just like your salary. So while this pot also provided like a lifeline for most people, it also comes with risk. So on the positive side, it reduces to the need for high interest loans when emergency strikes, or when you have an emergency and you need to access funds. And also, the frequent withdrawal could severely impact your long-term retirement savings, leaving you with less money when you retire. So this is why it's crucial to use the spot wisely and only withdrawing from it when it's absolutely necessary. And I think this is one of the things which most of the consumers last year did not understand, because there was a lot of withdrawals that took place from September. And obviously SARS was smiling about it, because why? That meant more tax for SARS. Then the second component is the retirement component, which is obviously your future security. So the remaining 2/3 of your retirement contribution would go into this locked retirement component. So unlike the savings pot, this money is strictly preserved for retirement. This is what it means, that you can only access it. You cannot access the funds early, no matter the circumstance. And when you reach retirement age, you can take 1/3 of the total amount as a lump sum that will obviously be taxed, and the remaining 2/3 must be used to purchase a pension or an annuity, providing you with a stable income in retirement. Now, the structure is designed to protect your financial future, and also ensuring that people do not reach retirement with little or no savings, which used to be the case prior to this being implemented. But while this also guarantees long-term financial security, it also means that individuals in serious financial distress cannot access these funds, reinforcing also the need to have a separate savings or separate emergency fund also set up. So what we're also looking at, this whole thing about the two-pot retirement system also pushed and drove clients or the working class to really sit down and consult with financial planners on what would be the best way forward. Is it wise to access my saving spot, or what would be the alternative to it? So with this being introduced and all the madness that went around it and the craziness, it also was a unique opportunity for financial planners or clients to engage with financial planners on how to plan their future and their retirement properly. Okay. So the reason why this system was implemented, um, the South African government implemented the system for three major problems that we had in this country, which was obviously preventing early full withdrawals. So before the system, many people would cash out the entire pension savings when changing jobs, leaving them with nothing for retirement. So when they start a new job, they literally start saving again from zero. And also the system locks in 2/3 of contribution, ensuring that the better stability in old age. Because imagine you starting a job at the age of 50, having withdrawn your whole fund. Now from 50, you only have another 15 years left for retirement, which means your contribution has to be much more than what you did because you're literally starting from zero. Then also, this providing emergency access to savings, which is also a good thing, but also very controlled. So with the rising debt and unexpected financial emergencies, many South Africans needed to have access, um, needed a way to access some of the money without wiping out the entire pension fund. And this also then creates a middle ground, giving access to part of the funds while still protecting the long-term savings, which is also a benefit to the client. And then just in enhancing retirement security. So South Africa has a low retirement savings rate, meaning that many people, when they reach retirement age, will reach it without money to live comfortably. And then also, by forcing workers to preserve 2/3 of their savings, the system ensures a better outcome for retirement and for future generations. Then the last thing was also, which also benefits the country, it reduces the economic pressure. So limited access to retirement funds reduces the need for people to borrow from high interest lenders, easing the country's household debt burden. And over time, this can also help financial stability on a national level. Is there any questions so far? Okay. So what does this mean for retirement planning, the impact on retirement? So for anyone that is planning to retire, the system brings both opportunities and challenges. The benefits of it is there is an emergency financial relief, which is the savings part that allows you to access those funds when you need it. Then there's also retirement security, which means that you don't have control over the 2/3 up until the time of retirement. And it also encourages a saving culture. Since withdrawals are no longer possible, people are encouraged to think long term about their financial health. So basically, what it means is um, previously a lot of people would depend on their pension funds and the fact that they could withdraw from it. Now um, it forces us now to actually look at other savings components, like an emergency fund or tax free. So it encourages and it also pushes and clients to really start thinking about saving properly and not just relying on this one component, which is the retirement. Then also the challenges of this would be the potential of then leaving them with less money in retirement. And that is also where the financial plan would come in to advise them on the overuse of the savings component, and then also the tax implications of it, because every withdrawal is taxed as income, meaning you might end with less money than expected. I do know that a lot of service providers last year was proactive enough to withdraw with all of the deductibles like tax and so forth. Then also limited access to retirement funds. Now, even in financial hardship, the 2/3 in the pot cannot be accessed early. So it also ensures that at least if something happens, as much as a client would need funds, um, eventually at retirement age, this funds is secured, which is going to benefit me at the end of the day. Okay. So to maximize the benefits of a two-pot system while avoiding the pitfalls, here's what individuals and employers can do in terms of navigating this two-pot system. So individuals and employees are only encouraged to withdraw when absolutely necessary. And that's also where part and parcel of our job comes in, where we advise individuals and employees what would be the wise way to actually go about it. And also supplementing their retirement savings. So look into savings options like retirement annuities or even tax-free savings account to build extra financial security. And then also the biggest part of the whole the need to touch your retirements. Now that's easier said than done, but all of these things can be done and can be accomplished with the assistance of a financial planner. Then from our side, we also do understand that the strain that this whole two-pot system and people not understanding it properly, the strain that it had put on employers and even retirement fund administrators, because why there were so many queries coming through. So some of the things that employers can do is to assist in offering financial literacy training on how to manage the two-pot system effectively, and also allow employees to have access to financial advisors who can help them make informed decisions. And that's also based part and parcel of why we approach SAEFA for this type of relationship, so that that responsibility does not solely just rest on the employers or the retirement fund administrators. And then also, if too many employees are withdrawing frequently, there can also be stuff that can be put in place, such as offer incentives for savings, or such as employee matching contribution. That's all based on the company's profile itself at the end of the day. So a lot of people saw the two-pot retirement system as some way of limiting um, us from our money. But the two-pot retirement system is actually a game changer for South Africa's financial future. And it offers a lifeline for emergencies while ensuring that individuals can still save enough for retirement. However, the key to making the system work lies in the discipline, the planning, and also the financial education around it. So, for people that took part in the first withdrawals last year, when this system was implemented, so a lot of people would ask. I know a lot of people withdrew from the savings spot without the knowledge as to, just because the money was available, the funds was available, and now that they have a better understanding as to how it can affect the overall retirement fund. A lot of people would ask, so what happens now that after I've already done my first withdrawal? And there is all is not lost. So what people need to understand, if they've already withdrawn from the retirement savings pot, it is important to obviously take the right steps to safeguard your long-term financial security. So while accessing these funds can provide, as I said, short-term relief, the key is to rebuild, to adjust, and also to plan effectively to ensure that your retirement goals remains intact. So this is also another part where the financial planner would then also come in, because then they can assist the client to assess their financial position currently. Start by evaluating where the withdrawn money went. Sad to say, a lot of people that withdrew last year never used the funds for stuff that would be important. Some used it for holidays, or but some just wasted the money. So was it used for genuine emergency? Was it used to pay debt, or for discretionary spending? So understanding this will also help us determine whether the financial adjustments are needed. And then next, we need to review the overall financial health by examining your savings, your remaining savings, your outstanding debts, and your monthly expenses. So this will give a clear picture of whether we need to adjust your financial strategy. And then also we need to consider the tax impact. So since the withdrawal was taxed at the marginal rate, we need to ensure the account for it. We also need to ensure you account for it in annual tax returns. So, and also budget for additional tax liability. Then we also can then rebuild your savings. So as I said, all is not lost, even for the people that has withdrawn, that can't account for that money that they've withdrawn. So if the withdrawal was made due to an emergency, it is essential to replenish the emergency fund. Then having a separate rainy day fund can help to prevent future withdrawals. The whole idea about the two-pot system is really to protect your retirement fund. So if we need to set up a separate fund for it, a financial planner can assist the client to do so. Then if your financial situation also allows, increase your voluntary retirement contributions gradually to replace the amount that you have withdrawn. Even small increases can make a significant difference over time. So additionally, what we're saying is, since you can only withdraw once per tax year, be mindful of this option again, unless absolutely necessary. Avoiding to tap into your into savings pot, so you can protect your retirement fund. Then there's also another one where we can adjust your retirement plan. So now that the savings pot has been reduced, we can then also recalculate your retirement goals. So determine how the withdrawal has impacted your overall retirement outlook and adjust it accordingly. Now, as I said, there is alternative investment options to compensate for the shortfall, which can be in the form of a tax-free savings or retirement annuities or unit trust that is also available for the client. And all of this can be then also explained in more detail to the individual by a financial planner. So professional can help you create a sustainable long-term saving strategy that can keep you on track for your retirement. So all is not lost, right? And then also going into the finer details of the client's day-to-day, which would be the change of spending habits and debt habits. So if the withdrawal was used to pay off debt, make sure you do not accumulate that new debt. Then also set up a budgeting plan that can help you avoid financial strain and prevent the need for future withdrawals. The only reason why some people withdraw from that fund is because they did not budget properly. And most importantly, avoid treating your savings pot like an extra bank account. So the more you withdraw, the less you'll have for retirement, and this could result in working longer or facing financial difficulties late in life. Then, if necessary, right, if necessary, you can also plan for future withdrawals. So if you find yourself needing to withdraw, plan carefully to minimize the impact. Only withdraw for essential needs and avoid using these funds for lifestyle expense on non-urgent spending. The time you withdraw strategically, and also if possible withdraw in a year when your income is lower to reduce your tax burden. Then final thoughts before I give over to Nsako. Withdrawing from your savings pot can provide some short-term relief, but it's crucial to use this option strategically. Now, the best way to really approach the two-part retirement system and understand also what you can do and how you should do it, the best way would be to really first sit down and consult with a financial planner that can take you through all of the benefits and also some of the challenges that it would present to you once you start withdrawing or once you start touching on your savings component. And thank you so much. That's all from my side for now. I'll give over to Nsako.
Morning, everyone. My name is Ntako. I got a, can you please enable me to share? Yeah. Yeah. And to share. My name is Ntako. I'm part of the team with Masthead. I'm also a financial planner. I'm just my camera so everyone can see me. I've been in the industry for almost a decade now. I started with Liberty and I'm independent now. I think as Lincoln has explained, we are part of the Masthead umbrella, but we all have our own practices within the Masthead umbrella. So Lincoln specializes in short term. I do long-term insurance. I also do short term, but I don't do commercial. So I specialize in estate planning, retirement, risk planning, investments. And in my practice, obviously, I have a chartered accountant. My business partner is a chartered accountant. So part of my service offering is tax planning and efficiency for both self-employed and for businesses. So yeah, that's me. So what I'm going to do in my section is just give you an example. So I'm going to show you a video because we didn't want to bombard you too much. I'm just going to show you a section of a YouTube video where they give an example of in the event that you do withdraw scenarios. And I would like to just highlight the one where it shows the impact that it has if your tax bracket changes, because when you do withdraw your savings component or from your vested, because for those that had already savings pre the 1st of September last year, already had a component where 30,000 Rand was taken from that vested component in order to create the savings component. So some people can withdraw more than 30,000 Rand because of the vested component that is there. And in the event that you do that, it does sometimes shift your tax bracket. And then what that means is that you find yourself ending up paying more tax. And that's just what I want to show you in the video. Okay.
Oh, sorry, Nsako, there's no sound. We can't hear.
Oh, sorry. You can you see the video?
Yes, we can. Yes, we can. We can see your shared screen.
See the video. Okay, let me just try and see. I think maybe I. Can you hear it now?
No, still can't hear. Still, there's no sound.
Yeah. Link, can you help me?
Okay, that's 100%. Let me take over. Just send me the link, and then can you just explain some more on that what you want to do? You can just send me the link, and once we're ready, we can share. But you can continue explaining.
Okay. I'll just stop sharing it. Are there any questions so far while I'm trying to figure this out? I do apologize for that. Any questions so far?
Or Lincoln, maybe you can continue. We can play the video maybe towards the end. Maybe continue with the presentation. I don't know.
Okay, 100%. Apologies, everyone. Yeah, these things sometimes when we sometimes when we do the trial run and the practice run, everything works fine, and then for some reason there's always gremlins in the system. So I do apologize for that. What I'll just share on quickly. Just 1 second. Okay, so what I'll share on quickly is just how employers and directors can assist in educating the staff on the two-pot retirement system. Workshops like this and also sessions like this assist us into actually setting up um, this type of settings to explain what it's all about, and also being able to use real life case studies to compare employers who withdraw from the savings pot versus those who preserve funds. So there's always opportunities and platforms that can be created um, by the employer to actually allow us to come in and also sit down and explain this in a more simplified or a more practical way to the employers. And then also um, a step-by-step guides explaining how contributions are split between savings and retirement pot, and also the tax implications, the long-term impact, and how to maximize retirement benefits under the systems. So all of that is available in the form of sessions like this, also in the form of information that we can share, which is readable information as well. And then also from our side, we also do offer one-on-one financial advisory sessions that is on request, where every employer's financial situation is unique. So personal guidance can help them understand how the two-pot retirement system applies. I think the whole purpose of everything is also just to make sure that in the event where anything happens where a worker or employer is in a situation where they have withdrawn and it is affecting now their long-term planning or their retirement, that we are able to then come in and then sit and deal with a client and help him assist and devise a plan to still secure his retirement, but at the same time, we're creating a happy environment for the employee to work on. So once we have sorted out some of his financial issues or his financial, some of the questions he has financially or so on in that aspect, the worker can really return to his workplace knowing full well that I've got peace of mind that all of these things that I used to stress about that could have affected my ability to work has now been sorted, and because of me having a one-on-one session with a financial advisor. So employers are allowed to book free sessions to discuss this type of retirement plans or any other financial questions that they might have when it comes to the two-pot retirement, or even when it comes to savings or even investment. And this will just be basically to aid for you guys to have a healthy work environment with obviously employees that has peace of mind in that aspect. Then also the pros and cons. There's some pros and cons that we might have already touched on, but I'll just rehash them again. Of the two-pot system, the pros is it provides short-term financial relief where employees can access the savings. It also it's lower withdrawal risk, so employees is not at risk of withdrawing the whole fund because it is at the limit, and then also contributions to the retirement savings remain tax deductible. The cons is the tax implications that we spoke about earlier, the frequent withdrawals, false sense of security, and potential mismanagement, right? And all of that, in fact, everything that we're speaking about regarding the two-pot system all ties into the fact that employers that wants to access this needs to have sit down with a financial planner to really discuss all of these things in more detail. So I'm just going to get into the video that Ntak wanted to actually play for us. Just 1 second.
Yeah, and just to reiterate what you're saying, the tax implications on that, I think that is the biggest one that really affects your retirement savings at the end of the day, because, and especially when you do withdraw, when you get to retirement stage, all the other withdrawals that you've had over your lifetime are taken into account. So over time, it really does deplete the amount of money that you will have at retirement stage.
Yeah.
Yeah.
Awesome.
Can you just skip it to the scenarios? I think it's 5 minutes because I just wanted that portion with the scenarios only. Yeah, that one. Yeah.
Right.
Example, say your annual salary is 300,000 Rand per annum and you want to withdraw 30,000 Rand from your retirement savings. Your withdrawal is going to be considered additional income in that you're going to be charged the marginal rate of tax that you would normally be charged for your day-to-day income or your salary. Let me give you an example. If you add the 300,000 and the 30,000, that will give you a taxable income of 330,000. Now, instead of looking at the retirement tax tables, under the two-part system, we'll be using the marginal rate tax tables. And this is what it will look like. So you want to go and look at the bracket that you fall under. The tax rate that will apply will be 26%. And so if you calculate 26% of 30,000, that will be 7,800. And so the net withdrawal, the amount that's going to be coming into your bank account, is only going to be 22,200. Now, say you actually want to withdraw 200,000. You still earn an annual salary of 300,000, but you want to withdraw 200,000, partly from your vested component and also from your savings component. That amount will be added together, and so your taxable income for that year will be 500,000. Looking at the tax tables, the tax rate that will apply to you will be 31%. Now it says 31% for the taxable income that is above 370,500. And so it's not going to just be a simple calculation of saying 31% of the 200,000. It's actually tiered because that's how our tax system works. And so I did a rough calculation, but obviously the final amount will have to come from SARS through the tax directive that your pension fund or your provident fund or people managing your RA are going to apply for. But based on my calculation, your net withdrawal will only be 141,525 if you want to withdraw the 200,000. So in general, I would say withdrawing from your retirement funds is not a good idea because it reduces the overall savings that you're going to have at retirement. And we know only.
Okay, yeah. So from that video, what I just wanted to highlight is the amount of money that you do withdraw does impact the amount of tax that you will be paying. So for those who already had the vested portion before the 1st of September last year, have access to a larger amount. But however, do keep in mind that if you do decide to withdraw a higher amount, it then affects your tax because the amount of money that you take is taxed according to the income, which is the income tax table, not the retirement tax table. And just that one difference makes a huge difference in the amount of money that you pay for tax. Yeah, so that's the one thing that I wanted to highlight. Are there any questions? Because it's been so quiet throughout. Are we all on the same page? Are we all understanding? I think our mics have been enabled. Nothing. Okay. I don't know, in the absence of questions, we have come and drawn to a close. We will make the the slides available, and if you have any feedback, do let us know. And we are here to just give you literacy on what you would want to hear from us. So if you do have suggestions in terms of what you would want us to present to, whether you as the employer or your employees, or let us know, and then we'll create a session for that and take it from there. Tiamo?
Ladies and gentlemen, as we conclude today's webinar, we want to express our sincere gratitude for your active participation and engagement throughout this session. We are pleased to inform you, as Nsako mentioned, that you will be receiving a comprehensive newsletter during the course of this month.
Oh yes.
Yes, we'll also share the presentation slides that we are presented today to the SAEFA management as well for distribution. We welcome your suggestions regarding financial topics that would be most beneficial to you in our upcoming webinars, whether it's retirement planning strategies, investment opportunities in the current economic climate, tax optimization, or specific industry-related financial challenges. We are eager to tailor our content to address your organization's particular needs and interests. Please feel free to reach out to our team with your recommendation, and we will work diligently to incorporate them in our future sessions. Once again, thank you for your time and your attention. We look forward to continuing this proactive partnership between SAEFA and the Infinitum Initiative. Wishing you all a productive day ahead. Thank you. Thank you so much.
Oh yeah, our contact details will be there, and also on the newsletter. I think that our first newsletter came out in December, so yeah, every quarter we will be doing the newsletter. Our contact details will be there. Yeah.
Thanks very much, team. Thanks, Lincoln. Thanks, Chiamo. Thanks, Nsako. Very, very insightful stuff. And you read my mind. I was about to say, please, can you share your contact details? And then up it popped. So thanks very much for spending your time with us this morning. I would like to I know that it's always difficult online. I experience this myself when nobody has necessarily any questions. What I would like to say, though, is if anybody does have a question that they would prefer not to share on this open platform, please feel free to reach out to the team. You're certainly welcome to reach out to me, and I'll pass out I'll pass your query on to the team so that they can assist you. Otherwise, you've got the contact details directly, and you can certainly get in touch with them. All right.
Yeah.
Sorry.
Go for it.
Yes, yeah. Sorry. When you said that, yes, we do, as part of our service offering, we do offer a complimentary session. I think Lincoln has said that. So if you do feel that, okay, maybe you'd prefer one-on-one, we can offer that complimentary session for you. Yeah.
Perfect.
Absolutely.
Thanks very much. All right. Awesome. Thanks very much, folks. Then in the absence of anything further, and once again, really, really appreciate your time with us this morning. And thanks very much for the insights. To the members, thanks very much for joining us. And as I said, any questions, come back to us, go directly to the team, and let us assist you wherever we can. Thanks very much, everybody. Have a great day going forward.
You too. Thank you so much, everybody.
Thank you.
Thanks. Bye.
Thank you. Bye.
Yes, bye.